Hi there, folks. This is Atilla Yesilada reaching out to you from Istanbul. It's the night of Tuesday, midnight, the only time during these hot days when my brain is somewhat functional. As you know, this channel is about Turkey and Turkey adjacent issues, but today this is a special. I'm trotting off the beaten path and address a very topical issue. Is the world hurling towards a full-blown financial crisis? Now, over the past 2 weeks, global markets have experienced two financial panics, contagious financial panics, meaning that from the epicenter, like an infectious disease, panic spread all over the world, whether the asset class or the geographical location in the world was affected from the particular causes of the financial panic or not. The capitalist system is inherently unstable and frequently experiences this kind of tremors. Very few of them turn into financial crises. I wanted to do this for two reasons. First, it's my paying homage to my former master, Professor Hyman Minsky, the author of the financial instability hypothesis. He wasn't my thesis advisor or anything, but I had the opportunity to work with him briefly during my stay at the Jerome Levy Economics Institute. I, in fact, wrote my PhD thesis on financial instability in American commercial banking system, which I never got published. I just dropped out of my PhD program. Didn't want to have anything to do with academia. But what I learned about financial crises and the irrational behavior that undergirds it has helped me a lot in particular, which I'm sure you would appreciate if you lived in Turkey or covered Turkey for any professional reason. Two, I'm not only a YouTube content creator, but I'm also a consummate consumer of YouTube content. And all day today, I was just, lounging around on my reclining chair, having a cold beverage, and watching all this crazy apocalyptic content about the Great Recession, it's over, the collapse of the capitalist system, and I had to laugh. I really had to laugh. For someone who has spent 35 years in the business and have seen a dozen such panic attacks and the harrowing crises of 2007, 2008, this barely registers on the radar, and it's going to blow over in a couple of weeks, if not days, with one caveat, and that's going to be the great reveal at the end of this video. What's happening? Markets panic. In a few days, they recover. And that's what happened on Friday and Monday. All the markets sold off. Of course, money had to go somewhere, so it went to American treasuries and other what we call safe haven assets. Bitcoin wasn't one of them, which is noteworthy. And then Tuesday, markets recovered again. What were the purported reasons behind this financial panic attack? Many have been mentioned, such as, of course, the American economy rapidly heading towards a recession, and Fed misreading the tea leaves once again and delaying rate cuts earliest to September. Two, the slowdown in Chinese economy, which could possibly, in conjunction with an American recession, could trigger a global recession. That the AI, artificial intelligence mania, was overdone. A lot of the investment is huge AI-related or social media companies are making is not going to pay off anytime for the investors. Valuations, of course, were extremely stretched, in particular in the case of S&P 500. War scare in the Middle East. And finally, and most importantly, the surprising rate hike by Bank of Japan, along with intent to cut monthly bond purchases at some point from 6 trillion yen to 3 trillion yen. Now, that was really a big blow to financial investors across the world, because a lot of them engage in a practice we call carry trade, which is essentially interest rate arbitrage. A carry trader borrows in the currency of a country where financing rates are very cheap, and then invests the proceeds into the currency of another country. It could be simply a cross-currency deal, or that person, that fund manager, could use those funds to invest into, say, Turkish, stocks, Turkish bonds, corporate bonds, etc. And the most favored carry trade currency in the world is Japan, where financing costs were, very close to zero. Whereas in the United States, Fed funds rate, the base for financing is 5.25%. Now suddenly, all the Japanese funds savings that have migrated abroad in search of yield started coming back, and Japanese financing costs have picked up. Moreover, a lot of experts think that this is not the last rate hike by Bank of Japan, and it could potentially push the policy rate up to 1% from current 0.25% within a year or so. So the undoing or the reversal of carry trades have contributed to the contagion effect, which means it spread from epicenter to all across the world. For instance, on Monday, the main index in the Istanbul Stock Exchange dropped by 5%. We're not affected by any of the potential causes I mentioned, except the specter of war in the Middle East, which I covered in my previous video. You know what? Call me a hack, called me a quack, but I don't think any of these were the reason behind the panic attack, because all of them were foreseeable. I mean, if the reason was, for instance, the specter of war in the Middle East, you would expect oil prices to have been spared from the sell-off. They didn't. Gold should have benefited. It didn't. So what's happening? I mean, why are these things happening? A lot of things in history and life are random. I found out through personal experience, and this is one of those things. Imagine if you watch nature documentaries, just imagine a wildebeest herd in Africa grazing serenely, and suddenly one of them smells a predator and spooks, and through pheromones, panic spreads across the entire herd, and rampage starts. They start bailing out from the area. This is what happens among humans too. We're essentially herd animals. Someone sells and everyone else follows, in particular when people think in their hearts and conscience that these rallies have gone too far, okay? As I've said, valuations have been stretched everywhere, and it's my personal opinion, but I think since inflation is never going to revert to pre-pandemic levels of almost zero, American government bond yields are still low at 4.5%. So it suddenly happened. One reason, to me, the most important reason was Warren Buffett's Berkshire Hathaway liquidating some of its positions, in particular, its Apple position. As you know, Warren Buffett is sort of the great guru of the investment world. And a lot of young fund managers looked at the old guy and probably thought, what the hell is he thinking? What does he know that we don't know? And they probably sold. Now, where do we go from here? Is the danger over? Because, by Tuesday night, after the Wall Street closed, when I'm shooting this video, markets have recovered somehow. Not fully, but somewhat. No, I don't think the danger is over. I think there is a realistic prospect of war in the Middle East, though I'm not so sure how extensive it's going to be or how long it's going to take. As I shoot this video, Hezbollah began its famous drone and missile attacks on Israel. Iran might potentially join soon. That would certainly precipitate another financial panic attack, and the markets will go down once again. clearly, Fed is expected to cut interest rates. I am not so sure it will. As I've said, I don't see American economy heading towards recession or unemployment hurling towards 5%, which I shall explain in a few minutes. And finally, the American presidential race. Kamala Harris injected new enthusiasm to the Democratic voter base, along with his new VP select Government Waltz of Minnesota. I don't know if she can win. It's too early to tell. So I'm not taking a bet on the outcome of the American presidential elections. But if Trump were to be elected, he could. He's a spoiler. He's a maverick. The things he promised, like levying an import tax on all imports at 10% and on all Chinese imports at 60%, are destructive. China will have to retaliate. Then the world economy may crash. And that was supposed to be the great reveal at the end of the video, but here you go. Nevertheless, it's kind of difficult to imagine all of these things happening together. And I will now tell you why I don't anticipate a financial crisis, which I define as a prolonged period of sell-off in a broad variety of financial assets, which then spills over to the real economy through credit spreads, availability of credit, or potentially failure of systemic financial institutions. Here are my reasons. Most importantly, the financial system is largely sound and stable. It takes not only a sell-off in financial assets, but the failure of major financial institutions to precipitate a full-blown crisis. And now both American and European banks undergo stress tests. They have significantly reduced leverage, and the bond rally is actually helping them to generate profits on the paper profits, capital gains on their huge bond portfolios. Of course, there are weaknesses in niche areas, such as some types of private equity. Of course, the whole financial dimension of the real estate sector is in deep trouble. Leveraged buyout loans, probably about a dozen small emerging nations are on the verge of default, and if they were to be excluded from the global credit markets for a long time, they could, declare a default, which could also have a contagious effect among other emerging markets. The world economy is certainly not close to recession, and I'm talking about hard data. I usually follow the global composite PMI to gauge where the world economy is. The latest reading as of end of July was 52.7, which, translates into healthy growth. It did slow down from the month before, which it should. That's what a soft landing is. Neither is the United States in danger of falling into recession anytime soon. Why? Again, look at United States Services PMI. It's very healthy. I also closely follow Atlanta Fed's GDP Now forecasting tool, or Nowcast. It's tracking third quarter GDP at 2.5%. Of course, no forecasting tool is perfect. They err frequently. But over the years, if you look at it over a period of a year, Atlanta GDP forecasts have turned out to be fairly accurate. At least they are not wrong in terms of telling you the direction. So in third quarter, contrary to what Atlanta Fed GDP Now says, economy might not grow 2.5%, but in any case, the potential growth rate, the NAIRU, non-inflationary growth rate of the American economy, is anywhere between 1.8 to 2.1%. So even 2% growth would be fairly good. That would amount to further employment gains. Now, clearly, employment has slowed down substantially, again, as it should. It couldn't have grown at a pace of 300, net gains per month. But there are also technical reasons here. First, of course, people have become more reluctant to hire immigrants simply because Trump might get reelected and, kick all of them out of the country, as he says. and a lot of technical issues like hurricanes, etc., etc. Again, data on that or views on that is not very precise, but it would probably take a payroll gain of 100,000 K per month to keep the unemployment rate stable, and the latest read was 114%. So we're far, far away from the employment data signaling recession. If employment continues to grow, albeit at a slower pace, consumers will have more money and they'll spend somewhat. Even before these financial panic attacks started, Fed and ECB were on track to cut rates. Now, honest people may disagree whether the first rate cut would come in September or December in the case of Fed, but eventually they will cut interest rates, which means financial conditions will loosen. And usually financial crises do not strike when financial conditions are becoming looser. And finally, as I've said, the sell-off in equity markets and other risky assets have been accompanied by a massive rally in American and German bonds, which actually does some of the heavy lifting for Fed. I mean, these rallies are tantamount to a couple of interest rate cuts. So, people are feeling wealthier, both banks and individuals through their 401k accounts. So we're going to see a very turbulent period. I think the best is over in terms of gains for major equity indices and corporate bonds and emerging markets. We're going to have this random walk across the Wall Street, as the title of the famous book once wrote. So no clear trend for risky assets, ups and downs, but essentially a period of waiting till major uncertainties resolve themselves. As I've said, a war in the Middle East to me is still not the most likely scenario. No one wants war. Iran certainly doesn't want war. Hezbollah doesn't want war. Netanyahu doesn't want a bigger war, though he would prefer a contained and prolonged war to make sure to save his political career and not to go to prison. So these escalatory attacks that we're currently experiencing, tit for tat, would probably stop at some point before Israeli army attempts to invade northern Lebanon, or Iran gets fully involved, which would force United States and possibly UK to defend Israel. Why would that be a game breaker for my thesis of all is well? Well, if oil prices were to shoot up 30-40% over a week, it would significantly weaken the world economy and make a significant contribution to headline inflation. Now, generally, central banks don't react to these kind of supply shocks, but we have seen in the past that pass-through from headline inflation to core inflation and other indicators that central banks follow is fairly substantial and rapid. And remember now, Fed's preferred inflation gauge is still at 2.5%. And if you add even a couple of decimal points on top of that, Fed is going to be very reluctant to cut interest rates, which sort of would bolster the bear case for financial assets. You got a war, you got higher oil prices, and Fed really not knowing what to do. I think the AI story is real. It's a transformative technology, and for reasons of simplification, when we're talking about the current multifaceted technology revolution, we're just saying AI, but there are just so many things going on. I mean, like in my case, the weight loss drugs and the Alzheimer drugs, both of which I am either using or will need very rapidly, are just going to change the Social Security landscape. It's going to make us live healthier, longer, and we will rely less on state-provided health services. Space technologies like commercialization of space. I can go on. I love this subject, so this is going to be a lengthy video. Please bear with me. like .com turned out to be a false hope. None of those companies ever made money. But these leading AI companies or high technology companies are already making money. There's solid business plans, and we can foresee that within the next 10 years, AI and related technologies are going to become an indispensable part of our personal and business life. So, they may be expensive at current multiples, but if they get cheap, people will buy. Also, I mean, both American commercial banks and the fund management industry is fairly liquid. This is why Fed's monetary tightening didn't work for a while, because banks have a lot of free reserves parked at the Fed. Last data I got from American money market funds that they had accumulated roughly $6 trillion in assets. That's money that can be deployed to riskier assets at any time. Less certain about where the fund management community stands. There are a couple of monthly surveys, like by Reuters and Merrill Lynch, and I think they keep roughly 5% of their assets in liquid form, cash and uncashable, so that they can deploy it to profit opportunities, and that's fairly liquid for the fund management community. So all in all, I mean, tighten your seatbelts. It's going to get very turbulent. The great rally is probably over. I'm really sorry. There's a huge difference between markets collapsing suddenly and that spreading to financial institutions and then to companies or to consumers in the real world. I think that link doesn't exist at this point. Now, the big reveal, which I already revealed, Trump presidency could change the game. I heard a quip by one diehard Republican who said, Democrats think Trump jokes when he says silly things. We take him very seriously. I take him very seriously too. The things he says may not be the wisest, but he certainly intends to carry through. And unlike his first term, he's surrounded by carbon copies of himself, other diehard Trumpists. So essentially, he's campaigning in an echo chamber where he doesn't hear alternative views. I mean, remember his first team, Mike Pence was a conservative, but also, a very centrist guy. Now it's different, and he's coming back for revenge. He said that. I think if he's defeated, he would refuse to acknowledge his defeat, which would lead to further unrest in the United States. If he wins, the biggest problem is United States may abandon its international role of assuring peace and the safe and smooth functioning of the global trade system and just become embroiled in its own divisions. Economically, though, his promises are hugely destabilizing. These tariffs he's talking about, are inflationary, which would mean that Fed would have a very difficult time cutting rates either now or in 2025. They would certainly elicit retaliation from China and possibly from EU. Reports have it that Brussels is already planning how to retaliate if Trump were to impose levies on their exports to the United States. It would also slow down world growth. It would accentuate the trend towards another iron curtain that's separate blocks. If he's correct, I mean, if he's sincere about cutting all military aid to Ukraine, Putin would walk all over Ukraine at some point, and then he'll start menacing other European countries, try to regain Russia's influence in Central Asia and Caucasus, and that's just geopolitical instability that I don't think any multinational company or global fund manager can ignore. His advisors are floating ideas of reducing the independence of Fed. I don't think that's going to fly in any Congress, whether controlled by Democrats or Republicans. But for fund managers to think that Trump is constantly breathing on the neck of Fed would politicize or would increase the perception of Fed making political rather than sound economic decisions. And that means an erosion of credibility for Fed. And reminding you that dollar is still the world currency, and the Fed is its keeper, its high priest. Any insinuation that Fed may not be playing straight is going to cause further turbulence. At some point, I mean, if Trump were to allow Putin to march to victory in Ukraine, that could encourage China to somehow attack Taiwan. It doesn't have to be a military invasion. Just a blockade would kill the world economy because Taiwan supplies almost all of the high-end microchips. Can these things happen? I doubt it. I think the Congress and at large what we call the American state apparatus is strong enough to withstand destabilizing moves from Trump. And not that he would want to change his rhetoric, but he will be unable to carry out most of his divisive and destructive political agenda. Of course, I use these subjectives or words like destructive. From my perspective, you may not think so, and I have nothing against Trump or Kamala Harris, by the way. But that's really the only threat to global financial system, and it could create a great financial crisis, in fact, even a growth or political crisis. But we will deal with that when we get to the shores of that river. Until then, stay safe, stick to your, preserve your mental stability, and watch out for our next videos. I'm grateful for your comments and for your subscriptions. This is Atilla Yesilada saying goodbye from Istanbul.